Commodities is part of the global products getting squeezed in the ongoing trade fight between Washington and Beijing. And the market is taking quite a lot of unhinging economies and exchange. So let's put all of this together into a global market space and get a sense of where we're heading with the very strong headwinds. Uchenna Minis is the chief analyst at Eagle Global Markets. Is live to us from our studios at the Stock Exchange. Good morning, Uchenna. It's good to have you on the show.
Good morning, Bosun. Thank you for having me.
Thanks. It's a lot of global headwinds as we speak. How do we put all of this together? It looks like one day it looks like we are seeing some clarity on the horizon, and the next day or by evening time it's getting very cloudy, trying to navigate ourselves out of the stormy waters. So right now we're dealing with Brexit, we're dealing with G7. The trade fight, it looks like the key parties, Washington and Beijing, are sitting down. Japan is also in there. South Korea has its own issue. The EU has its own issue with the US and all of that. So it looks like it's quite messy out there. We're not even sure who's coming up next on the radar.
So we can't really say who is coming up next, Bosun, but it's quite clear that the cumulative effect of all of this political risk is significantly pushing prices of equity and the market to the downside. And we also should add that aside all of this risk, there's also the precipitation of a slowdown in the macroeconomic cycle. We think we've exhausted that exponential growth phase now. We think we are at the top of the economic cycle right now, and all of this risk will just help precipitate and trigger this fall further, really, Bosun.
Yeah, one of the top guys at Standard Chartered said over the weekend that the likelihood of a U.S. economic recession within the next 12 months is now at 40% from our previous 25% level. Do you agree with this? Or do you think along this corridor?
Yes. Yes. We agree to that. And what's even worse is that as it is compared to the rest of the world, the U.S. still has a significant growth play. So the U.S. Rest of the world growth differential is still high. So we still expect that carry trade effect to continue to push the dollar to the high side, and in that way make that recessionary risk in the US quite significant if it materializes. So we think right now we have almost 82% about yield. The yield curves in the US all inverted, and that in itself is a key indicator for global slowdown in terms of recessionary risk, having that 9 to 12% lag phase. But we're expecting that too. And that's why you see the central banks are trying to find their way to try to nullify this effect prior to it even materializing.
So I want to make a trade, I want to play the FX, I want to do whatever at the global market space, but the economic conundrum between the U.S. and the latest all sectors SMI or Sales Managers Index for China is not looking good. Germany is trying to tiptoe its way back from a technical recession with Brexit also hanging over everyone between October 31st and the morning after. So how do I pick a trade, pick an asset, whatever? Where is the safe haven on planet Earth right now? Where do I get that umbrella from these headwinds?
I would have said you should go to emerging market space, but that would be me trying to shoot you at your foot. You can't do that right now because even the emerging market space will be facing significant downside risk, given you have contagion effect from Argentina, Turkey, and even China, given the Chinese yuan already trading above the 7.1 region, which is significant. We believe that the Chinese will allow its currency to weaken further to offset the tariff that Trump might be looking to impose coming September 1 or through to December. And if we had that, we would expect significant panic effect. I'm not even saying downside risk now, panic effect into the emerging market space. So we should be expecting significant downside risk going forward. However, in terms of investment, we will advise that investors and market participants choose to be defensive, look to short equities. You can also look for safe haven instruments such as precious metals, such as gold, the Japanese yen, and the Swiss franc can serve you as a place for you to hide that or diversify those portfolio in terms of your cash inflow, basically. We just advise that you be defensive in all in your allocation of assets and reallocation.
So quickly, how do you think frontier markets should consider the ongoing trade fight, Brexit, whatever it is? Nigeria, we're part of the frontier market. So how do you think we should take on board what's happening at the developed markets, at the contagion at the emerging markets, and what you already see on our own market street at the moment?
So for us, we have three significant issues right now, and it's not looking good from where we are standing. We still, as I mentioned, we have that emerging contagion risk. We also have a dollar strengthening problem. The U.S. rest of the world growth differential will always give that palatable carry trade effect where investors still try to come into the U.S. to look for in search for yield. Positive yield. Then we have the oil price issue. We are an economy that's significantly dependent on oil price sales, and as that the case is, any significant drop in oil prices kind of just tips us into that place of gloominess, and it's not looking good on all fronts. So so far we get this global geopolitical, global microeconomic slowdown. We would still expect that those effects to really weigh in on whatever growth potential we in Nigeria, frontier market, will be facing, given all the significance of all of this risks I mentioned.
Okay, great. So in terms of we're almost wrapping up the month of August. So do you think I should be scared or be seriously worried about September, October, November, and December? You have interest rate decisions in September, which will be key across major central banks around the world, Nigeria inclusive. Then we have the trade fight. Do you think anything could be settled between today and the weekend between Washington and Beijing before September the 1st, which is just a few days away? Then you have the ramping up of the rhetoric between China and the U.S. for October the 1st. Then you have December, which was the earlier push forward for some Chinese goods that are products that the U.S. says will be deferred until December. Do you think there are so many roadblocks ahead, and every one of us should tighten our seatbelts much tighter and be ready for the flight?
Yes, exactly. We should all tighten our seatbelt. But there's something I would urge people to understand, that especially the analysts and people trying to understand the market. When it comes to Beijing and the US, there's nothing tangible or logical in terms of analyzing what they get to do next. You have to be able to probably apply psychoanalysis to understand the personalities of these two head of states. You have to understand how egocentric these individuals are, and the chances of this coming to play in terms of having a trade deal settlement would really drag on in terms of having a truce or anything positively. So we are looking at that space that would Donald Trump cave in for such, should I say, benefit in terms of peace? But we think that ego is still going to come in. Xi Jinping will also try to protect the Chinese people in that regards. And if we have all of these things, we don't see any should I say, leeway or headway as regards to the settlement in terms of the U.S.-China trade war. So we expect that risk to continue up until December. Maybe a significant drop in the S&P, for example, can cause Donald Trump to probably retrace his stance. However, for now, we don't think he's looking in a hurry to give in to China, as it were. So we'll expect that risk. We also have the Brexit for October. Boris Johnson is trying his best possible to push for a no-deal Brexit. We also think that might be a black swan event, and if that has been priced into the market, that can also drag down indices prices in that way. So it's all round negativity.
Quite a lot there. So much to unpack in the current economic and market malaise. Thank you so much, looking for that horizon. Thank you, the silver lining. Thank you so much, Uchin. I mean, it's the chief analyst at Eagle Global Markets out of our studios at the Nigerian Stock Exchange. Thank you so much. Do have a great day. So we're going to take a bit of that Brexit and all of that straight into our London studios, where Juliana Olayinka is standing by. Of course, she's the one covering the UK market for us and the entire politics around the disorderly Brexit. Today is the first trading day at the London market after yesterday's bank holiday. Juliana, getting here into the conversation, give us a sense of how the market is starting off this Tuesday, the first trading day in London, and then we'll talk more about the hot water in which Johnson & Johnson found itself with the U.S. authorities.
Good morning, Bosun. Well, the FTSE has started off pretty sluggish this morning. It's lower at 21 points. I think really the sentiment is heating up around the possibility of a no-deal Brexit and the potential of Britain heading into a recession. Before the bank holiday weekend, there seemed to be a little bit of energy, I would say, around traders because, of course, there seemed to be a decent discussion with Merkel and a not so decent discussion with Macron, but at least it gave market traders something to work with. But a lot of people now are focusing really on their neighbours next door, and that's Germany, which is Europe's biggest economy. They have confirmed that their economy is shrinking and shrank by 0.1%. And UK investors seem to be nervously anticipating that Germany could actually fall into recession. Further away from home, it's the US economy data. They want to see if consumers in the US are starting to feel the bite of what's going on in the trade war. So at the moment, a sluggish start on the FTSE, but let's see if it picks up at intraday. Yes.
So let's track Johnson & Johnson. What is this with this opioid ruling in the US, the $500 million US? That's a masterstroke, Juliana.
Interesting, Bosun. For me and you, $572 million is a lot of money, but not so much for Johnson & Johnson. Their shares jumped 5.5% this morning at the back of that ruling from an Oklahoma judge yesterday. They were actually in hot water and they were fined by prosecutors $17 billion. So the fact that they've only been asked to pay $572 million is a huge sigh of relief there. What had basically happened is that they were accused of telling doctors to overprescribe their opioid-based painkillers, and that left to an epidemic of abuse and a lot of addiction. Some people actually had killed themselves with taking too much of this medicine. So it's also seen, this ruling, as quite a benchmark for other pharmaceutical cases that are currently in courts across America. And at that ruling today, their shares have jumped in other pharmaceutical companies. So Teva Pharmaceutical Industries, they gained 10%, Endo International gained 16%, and Cardinal Health 2.3%. So as I said, $572 million is a lot of money for the layman, but for the big multi-billion-dollar pharmaceutical companies, this is seen as a sigh of relief. However, Johnson & Johnson have confirmed that they will be appealing the verdict.
No. Whatever the amount, they're going to appeal that money, no matter how small it is to the market cap or the size of Johnson & Johnson. $572 million, you won't let go. It's very hard to come by with money these days with Brexit around the corner, so they don't want to lose anything. Of course, J&J says we're just 1% of that market in the US, so why should we get that fine? Thank you so much, Juliana. Keep an eye on the FTSE for us, as you said earlier, and see how it goes intraday today. Thank you so much. Have a great day.
Thank you, Bosun.
Yes, Juliana Olayinka will be back in the afternoon on our 1:30 show, Business Incorporated, with Chimeze Obiwago. Keep that in mind. Let's get back to the Nigerian Stock Exchange and talk a little bit more about the second quarter Capital Market Committee meeting. Quite a lot of issues were raised in the briefing given on Friday by the head of the SEC, Mary Udok. So let's get a bit of analysis and unpack that a little bit for our viewers who are trying to understand what was said at the CMC and the final. Let's talk to Wale Olusi, who is the head of research at United Capital. He's live to us from our studios in downtown Lagos. Wale, good morning. It's good to have you. Thanks for coming through.
Good morning, Boston.
Wale, thank you so much. So let's hit the ground running. Let's start with the multiple subscription program and the e-dividend. It looks like the SEC is making very strong headway here.
Yeah, I agree. I think they're making a lot of progress. From the statement released, they've been able to consolidate about 3.4 to 3.7 billion unit of shares. That's a lot of progress if you consider what happened between 2000 and 2008, where we saw a lot of growth in the primary market segment of the Nigerian capital markets, especially the equity space. And some of the issues that happened then were cases of people, buying shares via IPOs and public offers using different names. I mean, I come in as Wale Olusi, and then Olawale Olusi, and then Olusi, probably my other name in the middle. So the problem arises when the stockbroker is trying to, when the client is trying to sell off his shares, and then, paying them or crediting the account of such individuals in the bank becomes a problem, because the bank needs to harmonize the name of such accounts with the bank with the name on the shares, or when you want to open a CSS account, you now have, all sorts of names. I think what the SEC has done in the last couple of years is to look at the regulations guiding, all those kind of accounts, and I think they were able to relax it here and there, and then they sensitize the public to allow a lot of people who had such issues come in, so that we can look at those names that look similar and then proofs that this account actually belongs to these people, so that we can bring them together. But if you look at the number of units of shares that are currently listed on the Nigerian Stock Exchange, something close to 1 trillion units, compare that to 3.7 billion units that we were able to achieve. Of course, that number, that statistic might not be exact, but you will know that we still have a long way to go.
Yes, we still have a long way to go, but again, that's on one hand. So we're doing e-dividend on the other hand, and you think these two put together can help us resolve the unclaimed dividend, despite the fact that the SEC says the CMC meeting acknowledged that there's still rising incidence of unclaimed dividend, despite the technology, the ICT, and all of that in the market at the moment.
Yeah, I think the multiple share registration harmonization or consolidation thing is a huge step in our drive to achieve the e-dividend mandate thingy that we are trying to do. Because some of the issues with the multiple accounts is when you have such multiple accounts, those individuals will not be able to claim such dividends that are allocated to the accounts that are not tied to any bank account. So, but with the progress we've made now, I believe this will further accelerate the rate at which the success that we've recorded as far as e-dividend mandate is concerned.
Okay, Wale,
the SEC has also put in place certain measures to reduce that going forward.
Wale, just a second, we'll come back to you after the break. Just hold on those thoughts and let's continue that conversation for a few more minutes after the break. We need to drop this, then we're back into.